Just let me know if the Excel sheet is visible. Is it visible? Okay, thanks. Thanks for the confirmation. Yeah, guys. So, uh, Shivankar is asking me, we talked about the cash ratio and the liquidity ratios already, correct? We have discussed about them. And also, like, you'll be finding predefined modules also, like where I'm teaching via the live mode on the website section also, right? So you have these sessions there already. I'm just trying to give you a different opinion, a different view, right, upon all these metrics. हाँ, यहाँ पे उमेश, I had excluded the cash equivalents, right? Because in the cash ratio, you have the cash plus cash equivalents, right? Cash plus cash equivalents, and you're divided by the current liabilities. Correct. So यहाँ पे I just modified this cash ratio to make it a modified cash ratio so that I can just get to know about how much actual cash the company has in, right? Okay. So maybe I'll just go ahead in discussing initially two important metrics. We discussed about all these things in the previous session. I'll just go down. So see, two metrics is something that you need to understand very thoroughly. One is ROCE and the other is the ROE. Okay? There are two metrics. One is ROCE and the other one is ROE. So ROC stands for the return on capital employed. Okay, return on capital employed. And ROE is the return on equity. Now, you should have heard about these terminologies already, very commonly being used in markets. But ideally, we need to understand the difference between these two. Correct? Understanding the difference between these two is something which is of paramount importance. Right? So, अगर हम ROCE की बात कर रहे हैं, first I'll just write down the formula. What is ROCE? In ROCE, you have the EBIT, earnings before interest and tax, in the denominator, divided by debt plus equity. And in the ROE, you have the PAT divided by the outstanding shares. Okay? So firstly, we'll try to decode ROCE in a very simple manner. And I'll try to relate this to the practical scenarios as well, right? How does a financial analyst is trying to understand this ratio or trying to interpret this ratio in the form of clients or managers or different calls on which he has to explain about these companies' dynamics. Now, ROCE, the return on capital employed. You have EBIT in the numerator. You are having EBIT in the numerator, correct? And you have the debt plus equity in the denominator. EBIT in the numerator, and you have the debt plus equity in the denominator, correct? So give me a second. I'll just provide accesses to different people as well to join in. So two things are there. So two things are there that we need to understand. Just give me a second. Uh, Aditya, if you could connect the third Zoom as well. Just connect the third Zoom as well to this call. Yes, because I'm unable to access the third chat box. I'm having a two sets of people here, two groups, but the third room is not created. Kindly create the third room as well so that the people can post in their queries as well in the chat box. Okay. Yeah. So ROCE may you are having the earning before interest and tax in the numerator, and in the denominator you have the debt plus equity. So first we'll try to understand the numerator, the EBIT component, right? So this EBIT, which is your earning before interest and tax, it is the operating profit of the firm. EBIT, it is the operating profit of the firm, right? Here, it is a simple profit. You have just taken the total revenues and subtracted the total expenses out of it. Total revenues minus total expenses. Now, till this point of time, neither your interest nor the tax has been subtracted. Interest is yet to be subtracted and tax has to yet to be deducted, right? So this profit we usually call as the operating profit of the firm. So if someone asks you that what's the operating profit of the firm? The operating profit of the firm is EBIT, earning before interest and tax. And in the denominator, you have the debt plus equity. Debt plus equity, it is also called as capital employed. When you sum up your total debt plus total equity, it gives you capital employed. That basically means how much capital you have deployed in the business or how much capital you have employed in the business in terms of debt and equity, right? Because on a broader basis, the firm has two sources of finance, correct? If we talk about the capital structure of a company, so within the capital structure of a company, you have two sources of finance. One is equity and the other is debt. Now, you might argue about the preferred shares. Now, here I'm taking the preferred shares as a part of this component, equity itself. Correct? So, I've not tried to bifurcate between equity and the preferred shares. Equity and the preferred shares I'm taking in total as equity only, right? And debt. So, debt plus equity makes the total capital employed in a business. Correct? So, you are basically dividing the operating profit of the firm by the total capital employed. Now the question might arise is that why aren't I taking PAT here? Correct? Because if I talk about PAT, when you arrive at the figure of PAT, it means your interest has been subtracted and your tax has also been deducted. Correct? Because if from EBIT, I want to reach to PAT, firstly, I shall be subtracting the interest payment, then I will be subtracting tax payment. Correct? And only after that, I can get my PAT. Correct? But the major logic of ROCE, as the name suggests, return on capital employed, it is basically telling us how much return the firm is providing to the total capital employed in the business. And the total capital employed in the business is from both the equity holders as well as the debt holders' point of view. The total capital employed in the business is both from the equity as well as the debt holders' point of view. Correct? So that is why EBIT is the total profit which is available to both the equity holders as well as the debt holders. But if I subtract interest from my EBIT, if I subtract interest from my numerator, if I subtract interest from my EBIT, debt holders will be satisfied, right? Because what is the major concern of debt holder? The person who has given loan to a company or a person who has subscribed to the bonds or debentures or any other kind of fixed income security of a company, he wants the interest commitment back because the company has guaranteed some interest rate upon the principal value or the market value or the face value of that particular security, and the company has to fulfill the obligation. Correct? So that is a major concern. So if the interest is deducted, ideally, I need to remove my debt also from denominator. As a student of asset management, as a student of investment banking, we talk about the principle of consistency in valuation. The principle of consistency in valuation. That's very important. It means if in the numerator, you have an equity ka multiple, you need to have equity multiple in the denominator also. If you have an equity plus debt multiple in the numerator, you need to have an equity plus debt multiple in the denominator as well. So here, if you see in the numerator, EBIT is something which is available to both equity and debt holders. Interest has not been subtracted yet, right? So that is the reason we have taken both debt and equity. So that is why ROCE is trying to make you understand that it is the total return which both the capital providers of a company from an equity point of view and debt point of view make in terms of the operating profit of the firm. And higher the ROCE, it is good for the company. We should pick up companies having good ROCE. Correct? Then the second metric is ROE. It is the return on equity, as the name suggests. यहाँ पे it talks about only the return in terms of the final profit, which is available to the equity holders only. Here, I'm not concerned about debt holders. I'm just talking about equity holders only. And that is why, following the principle of consistency in the field of investment banking or valuation, from EBIT, I subtract my interest payment. Once I subtract my interest payment, my debt holders are satisfied. Then I subtract my tax payment. So once I'm done with that, I get something which is called as PAT, profit after tax. And I divide my profit after tax by the outstanding shares, only the equity component and not the debt component, right? And the interpretation or the logic remains the same. That the definition or the concept remains the same. ROCE is from both the capital providers of the firm, that is equity and debt, whereas ROE is only from an equity perspective. Correct? So that is something which is important to understand. Now, again, in case of ROE, we also want this metric should be as high as possible. Correct? Sometimes the company pays dividend also. Sometimes the company pays dividend also. So how is this dividend payment adjusted? Dividend is always paid after tax payment. The order you need to remember always: interest payment, tax payment, and dividend payment. So assume in this case, the company has also paid certain dividends, right? So after PAT, we need to subtract the dividend component also, correct? If a company has paid dividend, you also need to adjust dividend component also, which has been paid to the preferred shareholders or I would say, to the shareholders in totality, be it equity, be it preferred, be it as a total, right? This term, then you subtract your dividend out of your PAT. When dividend is subtracted from PAT, you call this term as EACS, and your denominator remains same. Denominator remains same, right? So sometimes people see EACS is earnings available to common shareholders. यहाँ पे C है earnings available. E stands for earnings, A stands for available, C stands for common, and S stands for shareholders. It is just a financial terminology which people use in the market. So many people tend to use PAT and EACS interchangeably, right? Because there is not of like much kind of difference between the two. PAT is much more simpler to write. PAT is much more simpler to remember in terms of remembering the word, right? But technically, like since you are a student of finance, you should know these technical terms. So if dividend has been paid, it is EACS, earnings available to common shareholders. And then the formula for ROE becomes EACS divided by outstanding shares, right? Ab, one thing here you need to understand as a financial analyst, right? And these things you won't learn in your normal graduation MBAs, because I'm trying to make you understand something which is out of the box. Or people as a financial analyst, right, try to undergo these things or try to understand these things, right? However, just listen to this point very carefully. Make a note of this. I'll upload the recording also on the website. The thing is, if in the capital structure, the company just has equity only and no debt. The company has no debt. The company is a 100% equity company. The company has raised each and every penny for financing its activities, for refinancing, for expansionary activities, for diversification activities, only via equity. No debt. Company के पास कोई कर्जा ही नहीं है. Right? In that case, you need to look at ROE. Correct? You need to look at ROE. Because see, in 99.9% of the cases in those scenarios where ROE and ROCE would be same, right? There won't be much of difference. It would just be a tax impact ka difference. Because if there is no debt, there will be no interest. Common sense. If there is no debt, there will be no interest, right? If there is no debt, you won't be having D here as well. So the only difference would be of EBIT and PAT, right? This would be a tax adjusted number and this won't be a tax adjusted number. So ideally, as a broader overview, in the most simplest sense, you should know if a company is an all equity company, you calculate ROE, it is fine, right? But if a company has debt, even if your company has a 0.1% debt, never, never, never rely on ROE. Now, here I'm not asking you not to calculate ROE, because as a student of finance, you might have to show these numbers, right, to the management, to your clients, to portfolio managers. But if a company has debt, never forget to calculate ROCE. Because whenever a company has a debt, ROCE will always give you a clear number. ROE will be manipulative. Never, never, never rely, depend, or trust on ROE if a company has a debt. Always trust on ROCE. And that is a major mistake which analysts do in the market, which people like you and me do in the market. Correct? So that is the thing we do not have to do. That is the mistake we have to stay away from. Right? Because assume karo, if a company has debt, if a company has debt and equity both, and I just calculate ROE, right? My ROE would be a superly inflated number, right? Because in my denominator, I just have outstanding shares. I'm not taking into account my debt, correct? Simple maths, fractions का logic है. That if my denominator is a bigger number, finally my ratio will be less. Yes or no? You agree with me? Guys in chat box. If my denominator is a bigger number, won't my ratio be a less one? Simple maths है. Correct? इसमें कोई logic तो है ही नहीं. Correct? That is the thing. But assume karo, if my company is a 90% debt company, my company has 90% debt. It's not bad to take debt up to 90%, right? Like, so you guys will be learning the logic as well in the modules and live lectures per se in future. It's not bad to take high debt, correct? 90% debt and 10% equity. Or assume the firm has 99% debt, right? And one equity, correct? This outstanding share ka number in denominator will be just one. Your ROE will be superly inflated, more than 100%, 200%, 150%, right? It seems something wrong. But when you will add your debt to it and calculate ROC, the number will drastically come down to below 50%, 40%, right? Because you are having a much more realistic denominator. So a company always having a debt, always use ROCE and not ROE. If you are using ROE in that scenario, the number would be inflated and that will be wrong. That is why if you watch CNBC TV 18, Bloomberg, Z Business, NDTV Profit, the core finance news platform channels, many of the analysts who come from companies side, they talk about our company's ROE is this, it is 20%, 30%, 40%. ROE can be a superly magnifying number. It can be 40, 50% for a company. Whereas if you compare the ROCE of a similar company having an ROE of 30, 40%, ROC will be just 15%, 14%, 12%. And that's the utmost reality. Now, the question that might come in your mind is there is a benchmark number that we should look for ROCE? See, for ROE, right, there is no benchmark number. It can be 100%, 200% also. But for ROCE, at least the company should have a 15% ROCE, minimum ROCE. If I talk about Nifty 50 index, which comprises of the top 50 market cap companies, the combined ROCE of that index is 13.5%. Average 10 years, I'm telling you. Over an average 10 years, the combined ROCE of the index had been 13% or 13.5%. Correct? But if you can find good companies having ROEC more than 13.5%, be 15% per se, that's a very good number. So as an industry standard, at least minimum 15% should be the ROC of a company. उससे नीचे नहीं जाना. Correct? So that's a good indication to assess a company, and there is a difference you should know. A company might have a 40, 50% ROE, but the ROCE might be just 8%, 9%, 10%. And that is a difference we need to know. Correct? That is one thing. I'll just reshare my screen once again with you. Yeah. The screen. So you might have heard or might have seen these kind of equations, correct? So this basically we call it as a dew point analysis. We're trying to break down ROE, right? Just a second. Just write it here. This is something which you called as your dew point analysis. Dew point. Sometimes in the interviews or corporate finance, right, or investment banking, asset management, they tend to say, "Our break down ROE for us. Break down ROE for us." They won't say explain us dew point analysis. They use this term, everybody knows, right? That in case of dew point analysis, we are trying to break down ROE into different segments. So just ask you directly, please simplify or break down ROE for us into different components. Correct? There the person tends to get confused. So here we need to understand how is ROE derived, right? And how does all these three factors impact your ROE, right? Again, that is something which is very important to understand that what affects ROE, correct? Your PAT impacts your ROE. Everybody knows. Your outstanding shares will also impact ROE, correct? As a I would say a mathematical basis or a fractional basis per se. But how this ROE is derived and every component which is helping you to derive this ROE is impacting the ROE at the end. Correct. So it comes from the net profit margin into the return on assets into the financial leverage. So these three components make up your ROE. These three components make up your ROE. If I talk about the net profit margin, the net profit margin is the net profit divided by the total sales. It simply tells you that how much profit the company is able to make basis the sales, right? So how much sales or how much revenue you make for sales are getting converted to profit. Higher the ratio, it is good for the company. And here by net profit, I mean PAT, correct? Into the return on assets. The formula says total sales divided by total assets. And here you have both the fixed assets as well as current assets. I mean to say both the non-current assets as well as the current assets. And in the numerator, you have the total sales. So this ratio is basically telling you how much sales the company is able to generate from the assets deployed to make up those sales, right? What do I mean is, if you deploy some plant machinery into a factory, that plant or machinery will be used to produce goods and services. Of course, goods, not services, but basically your goods and merchandise, right? Those goods and merchandise will be sold in the market, correct? So your assets that you have deployed are directly or indirectly helping you to boost sales because anyways, the products or merchandise or goods are coming out from those factories only, from those plant and machinery only, right? So again, this ratio should be as high as possible. It means, but if we can have a situation that by deploying a lower amount of assets, by having a lower amount of fixed cost expenditure, if we can make larger amount of sales, correct, that will boost our return on assets. If a machinery can deploy lesser amount of assets, if a company can have, if a factory can have a lesser amount of fixed assets, and the products it makes out of those machineries and the sales it makes out of by creating those products or services or goods or merchandise is very high, that company is superly productive, right? And same logic comes up in the first metric also. If by a lower amount of sales, the profits can be maximized, that's a very good profit structure, right? Or a business model. But that might not always work for every company because some companies focus towards like much on the volume, and some companies tend to focus on price, right? If I talk about the automobile industry, if I talk about the Marutis, or if I talk about somewhat Tatas, or if I talk about Mahindras, they focus much more towards volume, right? And less upon pricing. They aren't towards the premium segment like BMW and Audi, right? The volume being sold by a Maruti being highest, of course, then by Mahindra and Tata are highest, and their pricing is less as compared to the other peers, which are into the luxury segment, right? So these peers like Maruti or Tata or Mahindra, they're focusing much more upon volume, and based upon volume, they're able to convert it into profits. But these brands, these called luxury brands, like your Mercedes or BMWs, Audis, right? Range Rovers, all these are focusing towards premium sales. the sales are less, but the price they command on a per unit sale is very high. Correct? So as per the business model, there might be some nuances in the ratio. But if the company can convert its sales into profit, again, that's a good metric, right? And coming back to the return on assets, and that's again a very good metric. And if your firm can have a lower fixed cost and you can make more sales out of it, right? Or if you say, if with a limited amount of sales, right? Or if the change in sales, right, give you much more EBIT, having a fixed cost structure or a lower fixed cost structure. If there is any change in the sales that is able to magnify your profits, again, that is also very good. And that is where the operating leverage tends to kick in, right? There is a concept called as operating leverage, right? Like you'll be learning about these operating leverage, financial leverage, combined leverage in the modules as well. But there's a concept called as the operating leverage, correct? It is basically telling you that if your fixed cost structure remains the same, that's a fixed cost assets ka deployment, plant, machinery, factory. Or if you're able to reduce your fixed cost deployment, right? Either of the scenarios, either try to balance it out or maintain the fixed cost, or try to have a reduction in the fixed cost. Any amount of change in sales, because those fixed assets ka deployment less low or stable will be ultimately impacting your sales, correct? As told you previously just a minute back. So whatever there is a change in sales, correct? There can be a good magnifying impact upon the EBIT. If we are changing sales by a certain percentage, but the multiplier impact of the increase in sales or change in sales is much more higher in terms of profits. There the operating leverage tends to kick in. Correct? We want a higher operating leverage in a firm. If by a lower amount of sales or a lower amount of change in sales, we can produce maximum profit by deploying a good quantity of a stabilized or reduced fixed assets. That's very good for us. Our operating leverage will rise. Correct? And operating leverage tends to flow down from top line to bottom line. By top line are the sales, right? If we talk about the profit and loss statement, the top line of the business is the sales, and the bottom line is the profitability. The profit after tax is the bottom line. EBIT is not the bottom line. Some people tend to get confused. Ki bottom line is PAT or EBIT. PAT is the only bottom line. So your operating leverage, which is linked to this ratio of return on assets, right? It flows from top line to bottom line because it's linked to sales, right? Sales में कुछ changes हो रहे हैं and that will get impacted upon the profitability, correct? So that is the operating leverage. And the third one is the financial leverage. It basically tells us simply how much debt the company has taken. How much debt the company has taken, higher the debt, higher would be the financial leverage, right? This is assets by equity. This is assets by equity. It is being denoted by assets by equity. Correct? Ab ROE, if your financial leverage is rising, if this number, your financial leverage is rising, I'll come to the first metric first to make you understand. If your net profit margin is rising, ultimately your ROE will also rise. That is why the analysts who come on the social media platform, they use this complicated terminologies. The company is expected to deliver a good profit margin. The company's ROE, ROC will be really good, right? So all those things will be there, correct? And if the company's return on assets are really good, the operating leverage has start to kick in, the profitability is really good, and ultimately the ROE will be high. We do not get to know that how the ROE is linked to the net profit margin, how the ROE is linked to operating leverage, how the ROE linked to the return on assets, how is the ROE linked to the financial leverage? We don't understand. It is quote complex terminologies and that will boost the ROE. And हमको पता ही नहीं है यार how will it boost the ROE? Correct. So ultimately we need to understand if your net profit margin is rising, your ROE will rise. If the return on assets are rising, if the efficiency of the business is rising, or the operating leverage has start to kick in, it is also rising, your ROE will rise. But if your financial leverage is rising, again your ROE will rise. So all these three components, when they are rising, your ROE will rise, and you can derive the ROE. What is ROE? ROE is your net profit by the equity. If you cancel it out, sales से कट जाएगा, assets से कट हो जाएगा. So it is your net profit by equity itself. We've just tried to derive the formula for ROE from this. So always, as a student of finance, as an analyst working into investment banking firm or asset management firm, we want the net profit margin and the return on assets to be as high as possible. But we do not want the financial leverage to be high. But we do not want the financial leverage to be high. It can happen that the net profit margin is extremely low. The return on assets is extremely low, means the company is not generating any profits. It might be at the break-even level. The company's return on assets might be sheerly low, but the company has huge debt. The company is not productive. The company might go into bankruptcy. The financial leverage might be 100%, right? It means equity component will be less. When will this financial leverage be a high number? Simple maths. When your denominator, equity will be less, correct? Well, equity less hai, it means your debt is more ultimately. Common sense. So this ROE can be 100%, 100% also, right? So your ROE, if your ROE is rising on account of higher financial leverage, it is not good for the firm. But if your ROE is rising on account of the higher net profit margin and higher return on assets, it is good for the firm, right? And that is something we need to be cognizant about. And that is where they try to break down this. Which factor is contributing to the rise in ROE? If financial leverage only is contributing towards a rise in ROE, it means something is bad in the company, right? And if the ROE is rising on account of the net profit margin or return on assets, it is good. Now, here I'm not meaning that financial leverage should be zero. There will be some amount of financial leverage, 40, 50, 60%, depending upon the industry, correct? But the largest quantum should be on account of the net profit margin and return on assets. That is the major sense, right? Any questions, anybody, till this point? Any questions, anybody? ठीक है. Let's discuss about one valuation ratio. I have one question. How can financial leverage be explained as assets by equity? See, assets and equity. So this ratio is basically telling you how much assets have been purchased via the use of equity. Correct? But if this equity component is declining, it automatically states that the debt component is rising and the majority of the asset purchase is getting funded by debt, isn't it? If this equity declines from 90% to 50% to 40% or hypothetically 20%, the only source of capital is 80% of debt because that capital structure should be 100%. If equity is 20%, then remaining 80% kya hoga? It will be just debt only, right? Because that capital structure is just composed of two things, equity and debt. Correct? Got my point? So if this component is falling, it means there is higher debt. And all these asset purchases are getting funded by higher debt and lesser of equity or no equity. ठीक है. अब बात करते हैं एक बहुत इंपॉर्टेंट रेशियो की, राइट, इन द वैल्यूएशन फील्ड. Very important metric, very important ratio. You might have heard about PE ratio, price earnings ratio, price to earnings ratio. Very important ratio in the field of valuation. Anybody who's talking about the price to earning or anybody who's talking about the valuation, he starts the discussion with the price to earning, right? We do all these things, you learn all these things in the financial modeling session also once we do such things practically while creating a financial model, right? So this P ratio is something which is very important. अब अगर मैं P रेशियो की बात करूं तो this PE ratio talks about the current market price in the numerator divided by EPS in the denominator. the current market price of a share in the numerator, and it is divided by the earnings per share of that particular stock in the denominator. Now, before calculating this, it is also important to calculate EPS, because EPS again is a derived number. How will we calculate EPS? Current market price of the share, you will simply get from Google or BSE or NSE. If you want to calculate the price to earning for any of the companies in the market, for example, you want to calculate the price to earning for Infosys. Infosys belongs to the IT industry, correct? Simply go to Google, share price of Infosys, you'll get it. So here you have to take the current share price. If I am calculating the price to earning of Infosys as of today, it's no stock recommendation. But if I'm calculating Infosys ka price to earning as of today, I will take the price of Infosys as of today only. I won't be taking the price as of the 31st March 25 or the 31st December 24. No, today's price. But EPS is something that we have to calculate. And EPS ka formula is nothing but your profit after tax, right? By the outstanding. Okay, even if you see here, I mentioned here, earnings per share. Net profit available to the equity holder by the number of outstanding shares. Correct? Number of outstanding shares. So PAT divided by your outstanding shares. Whereas in your ROE formula mein, this was more of the total value of shares. Just to make you understand. A total equity funds. Right? That is the total number of shares into price. Total equity. Kitna hai company mein. But in case of EPS, you have the number of shares and not the total equity of a company in amount. Correct? You just have the number of shares. Correct? So PAT, I'm dividing it by the outstanding shares. So once I know PAT kya hota hai, I know what are outstanding shares. And this number, once you calculate, it becomes your denominator. So EPS in the market is a proxy for profit. Earnings per share is a proxy of profit. Correct? Higher the profitability of the firm, higher would be the EPS. Higher the profitability of the firm, higher would be the EPS. Lower the profitability of the firm, lower would be the EPS. So EPS is basically telling you that how much profit the company is making on a per unit share basis or on a per share basis. So ideally, we want that over a 1 rupee worth of share or simply over a 1 share, the company should be making higher profit. And if that is the scenario, the EPS would be high. Correct? So this price to earning ratio, it basically keeps your current market price in the numerator divided by the earnings per share in the denominator. Correct? So this price to earning ratio is basically telling you that how much we are willing to pay to purchase this company's share, right? I'm telling you the conceptual definition. How much we are willing to pay as an investor for this company's share for a $1 worth of earnings of a firm, or simply for a $1 or 1 rupee earnings of a firm. If a firm is generating a 1 rupee worth of earning, how much price we are willing to pay for that earning. If the price to earning ratio comes out to be 2, for example, the price to earning ratio for any company is 2. It means for a 1 rupee worth of earning for that company or a $1 worth of earning of that company, we're willing to pay $2 for that. There are some companies in market or many companies in the market having a price to ratio of more than 100, right? Zomato is trading at a price to earning ratio of 1000. It means for a 1 rupee worth of profit after tax of a firm or a 1 rupee worth of EPS of a firm, I'm willing to pay 1000 rupees for that, right? So that is the thing. Though the price in the market might be currently trading at 305, 308 something, but I'm willing to pay up to 1000, right? So that was the price to earning basically tells us. Now, price to earning ratio is something which you can use for mostly all the industries. It can be used for mostly all the industries, except for the BFSI space. You can't use price to earning ratio in the BFSI space. I'll tell you why. But you cannot use price to earning in the BFSI space. In BFSI space, you tend to use something which is price to book value. So we'll do it today, like if we have time. If not, we'll do it in the next session. But price to earning ratio could never use in the BFSI space, be it the private sector banks, public sector banks, NBFCs, insurance. You cannot use price to earning ratio for them. Price to earning ratio can be used for any of the industries apart from the BFSI space. Also, it is not encouraged to use price to earning ratio for heavy industries also, like cement, infrastructure, capital goods, real estate, right? It's not advisable to use price to earning for such companies as well. Correct. Because those companies are based upon book values. They have a lot amount of assets with them. Heavy companies है ना, infrastructure की बात करो, चाहे capital goods की बात करो, you talk about cement, those are heavy industries. Huge factories, cement की बोरियां, machine, plant, buildings, steel, right, marble, all these things are heavy industrial companies they are. Correct? So price to earning you can't use in there. But many people in the market still use price to earning for them, which is not encouraged ideally, as per my knowledge and as per many of the people in the industry who agree to it. Right? It's not something which I have created or invented कि price to earning use नहीं करना. Even before I was born, these kind of theories are these kind of theories were there in the market. कि price to earning should not be used for all these things. Correct. So price to earning can essentially be used for lighter companies or semi-light companies. IT के लिए you can use. इवन ऑटोमोबाइल इंडस्ट्री की अगर हम बात करें, दे कम इन अ सेमी हेवी कैटेगरी और सेमी लाइट कैटेगरी. दोज आर नॉट सो हेवी एज योर इंडस्ट्रियल सीमेंट रियल एस्टेट टाइप ऑफ कंपनीज, राइट? सो इवन फॉर ऑटोज यू कैन यूज प्राइस टू अर्निंग. मीडिया है, हेल्थ केयर है, एफएमसीजी है, राइट? सो प्राइस टू अर्निंग इज बेनिफिशियल फॉर लाइटर इंडस्ट्रीज. स्टील इंडस्ट्रीज, मेटल्स, ऑयल एंड गैस प्राइस टू अर्निंग कांट बी यूज्ड. टेलीकॉम प्राइस टू अर्निंग कांट बी यूज्ड. बिकॉज टेलीकॉम में क्या है, some people still tend to use price to earning, but their price to book value or PV to EBITDA is a metric that is used. Like we'll talk about this. Correct? Because telecom maybe there's huge infrastructure, huge amount of infrastructure is there. Towers बनते रहते हैं. 24 hours they're building up towers and lines. Everywhere they have to build up towers. They have to build up that infrastructure for towers, spectrums, all these things are there. The huge capital intensive sector, right? IT is also capital intensive, but not in terms of hard assets. You have the research and technology there, patents and copyrights. Those are intangible assets. IT companies are spending upon AI, intangible assets, research and development. Correct? But not upon purchasing factory, plant, equipment, machinery. Correct? So that is the reason. Also, that here comes about the drawback of the price to earning, right? कि सब इंडस्ट्रीज के लिए इस रेशियो को यूज करना ठीक नहीं है. नाउ one more thing. We talk about this current market price. I talk about this current market price. The current market price is a leading indicator of the market because it tends to change on daily basis, right? Either we can call it as a leading indicator or a coincident indicator. कुछ भी कहो, but it keeps on changing on daily basis. As a student of economics, the three types of indicators: leading indicator, coincident indicator, and lagging indicator. Lagging तो बेकार है. Lagging indicator doesn't tell you what's going to happen in future. Coincident, what happens, it impacts the current scenario. Whereas a leading indicator, it changes before, even if something can happen in future. Like for example, we talk about bond yields, YTM. If the yield curve is rising, inverted, flattening, we can get a sense about the future perception of risk in the market or the future scenario of the market in terms of a recession, a boom period, or different things. Correct. Whereas current market price also tends to change. So we can call it a quasi leading indicator or a coincident indicator, because if something news comes in the market, if there is a positive sentiment, the stock price might rise. If there is some negative sentiment, the stock price might fall. If there is some internal news coming up in the market, it will get priced into the current market price. But on daily basis, the price will change. Even by small decimals, it will change. But EPS is something that you do not get on daily basis because the company declares the profitability either on quarterly basis or yearly basis. Correct? you get the quarterly statements of a company, or you get the annual report of a company in which you can get the profit, outstanding shares, and calculate EPS. So EPS becomes a lagging indicator because my previous year's EPS is not telling me that what will be the EPS in future. The financial modeling and valuation maybe talk about the prior performance indicates the future performance, but not always. And there also you aren't using EPS to predict future. You are just using your past revenues and expenses to calculate the future PAT. And from PAT, you are calculating your forward EPS. Correct. But the thing is, पिछले क्वार्टर का जो ईपीएस है या जो पिछले साल का जो ईपीएस है, इट माइट नॉट इंडिकेट कि फ्यूचर में कितना ईपीएस होगा. बेसिक सेंस. सो ईपीएस बिकम्स अ लैगिंग इंडिकेटर, right? So that is the thing. And there is an overcome to this limitation. We try to redefine the PE ratio and we'll talk about it. Correct? We'll try to overcome this limitation. Now, your PE ratio is being impacted by three major important things. One is the interest rate in the market, the risk in the market. Interest rates and risk are related to one another. Third is growth. Again, the growth is also somewhat linked directly or indirectly towards the interest or risk. But three major factors which tend to impact your P ratio. These are the technicalities I'm telling you. No book will give you this, right? अब interest rates से मेरा मतलब है interest rates in the market. What the Fed in the US, what the RBI in India has set it. Correct. So usually what happens when the interest rates in the market, and it is usually what happens, it doesn't indicate that whatever kind of relationship I'm telling you right now will work always. But usually it works. And that knowledge you need to have. So usually when the interest rates in the market are rising or the interest rates in the market are high, the price to earning ratio should be low or can be low. Not guaranteed, but can be low. Why? That you will learn much more practically in case of financial modeling and valuation. But just to give you a fair idea, when you create the financial model for a company, your first task is to calculate or calculate the expected future cash flows. You'll learn how to do it practically, not to worry for that. ऐसे मत सोचो कि मैं बस बोल रहा हूँ मैं कराऊंगा नहीं. You learn about these things. वो modules में भी हैं. We'll touch base in the live lectures also. Forecasted cash flows. That future cash flows that you have calculated, you have to discount those future cash flows by a certain discount rate. जो भी हम कैश फ्लोज कैलकुलेट करेंगे फ्यूचर की CF1 plus CF2 plus CF3, you have to discount these cash flows because these are the future cash flows. You have to arrive at the present value of these future cash flows because you want to know the valuation as of today. Because you want to invest in market today, na? I'm not thinking to invest in market after 3 years. So after 3 years, if I will get some positive cash flows, all these kind of back-end calculations I need to do at the back of my head. I needed to do some kind of rewiring in my brains and calculate such things. Correct. So I'll be discounting these things by a certain discount rate. By a certain discount rate to calculate my present value. To calculate my present value or the intrinsic value we tend to call it. Intrinsic value. Simply आपके लिए मैं बोलता हूँ अभी के लिए like is the present value. Now this R is not the interest rate. It is your cost of capital. It is your cost of capital. This cost of capital is being denoted by KO. O is a subset. It's also called as your weighted average cost of capital, WACC. I'm not going to over this complex terminologies as of now because we're yet to learn about it, right, in modules and live lectures. So just to give you an overview, it encapsulates both your cost of debt and cost of equity. Your cost of capital, it comprises both your cost of debt and your cost of equity. Cost of debt क्या होता है? Is the interest rate that you are paying on debt. Simple logic. And cost of equity क्या होता है? The expected return that an equity shareholder will get by investing into your company. Everything is being done. Everything is being adjusted with tax. And you get something which is cost of capital. So we'll be learning how to calculate cost of capital also practically. Cost of debt निकालने का भी एक तरीका होता है. Cost of equity निकालने का भी एक तरीका होता है. All these things we'll learn. And once we apply some specific iterations, calculations, and formulas, we get the cost of capital. Now, this is governed by interest rates in the market. Indirectly, if the interest rates in the market are high, your discount rate, this R will also be high. Though this R is not exactly interest rate, If interest rate in the market currently, as per the RBI, is 5.5%, I won't take 5.5% here. This number will be 3%, 2%, or might be some different number, but not 5.5%. Because interest rate is an input in calculating your cost of capital. I'll tell you how. बाद में. ठीक है, like when we reach there. So interest rate, so current market में, the interest rate that is prevailing, it's used to calculate your cost of capital. It's an input. It's one of those many inputs that's used to calculate cost of capital. And if one of those many inputs, that's the interest rate rises, common sense, your cost of capital will also rise. And when your cost of capital will rise, your denominator will become a larger number. Your denominator will become a larger number. Cash flows won't be impacted much. Interest rate से cash flow को इतना फर्क नहीं पड़ने वाला, right? They won't change much. So as a result, the valuation of the company will squeeze. The valuation of the company will come down, or the present value of the company will come down because your denominator has now become a bigger number. It won't be a much bigger number as compared to cash flows. It will still be a smaller number compared to cash flows, common sense. But it has become a number which is bigger than the previous number. Then like a 2% now it is 6%. So anyways, the valuation will compress. And as the valuation come down, the price to earning will also compress. And because anyways, all this valuation is being done to calculate price to earning only. Correct. But when the interest rates in the market are low, when the interest rate in the market are low, this cost of capital will also become low. Mathematically, your denominator, if it was 6%, it will become 3% now. For example, we do such things practically also. The valuation will boost up and the price to earning will also rise. So interest rates usually have a positive relationship with price to earning. If the interest rates are falling, price to earning will fall. If the interest rates are rising, price to earning will rise, but not always. As we can see last year or last year, the interest rates were high in the market, 6.5%, 6.5%. But small cap, mid cap, and large cap was sheerly overvalued. They crossed all the limitations, all the past averages. And there was a bubble in the market in all the nifty large cap, mid cap, and small cap space. And it was 6.5% interest rates at that time. Right. So this concept might not always work, but it will work over a long term in the market. Okay. Then risk. Risk ज़्यादा है, then interest rate भी ज़्यादा होंगे market में. Right? The risk is more. Your cost of capital, that is KO, will also be more because your cost of capital is a measure of risk. Interest rate is one of those many inputs which are used to calculate risk, right? So if something asks you that what is cost of capital, cost of capital is denoting the riskiness in the cash flows of the business, how risky the business is, whether it will be able to generate cash flows or not, right? So if the business is highly risky, your KO, that is cost of capital, will also be very high. But if the business is less risky, your cost of capital will be very low, right? So risk is linked to interest and growth. If you are a high growth business, the price to earning will be high. If you are a high growth business, your price to earning will be high. Correct? Because usually what happens, the market is pricing in that the company will really grow well in the future. And hence your numerator price is rising at a very high rate. Because there's positive sentiment in the market. Same is happening with Zomato, like which is now being named as Eternal. All these things happened with Nykaa, the Policy Bazaar. Same thing is happening with Zepto in the unlisted space. It will get listed early next year, right? So they're pricing in. चाहे company में profit कम हो या बहुत ही कम हो, but they're pricing in, right? The company will do really well in future, and hence the sentiments are impacting the price. So these things are linked to the price to earning. Any questions, anybody, as of now? Any questions, anybody? Raghav asks me, on account of certain geopolitical tensions that we feel in the environment, in the macro space, how will it impact your PE? See, Raghav, your geopolitical tensions are increasing the riskiness in the market. Risk can arise out of anything. It can be geopolitical tension, it can be some recessionary concerns, it can be some black swan event, some tsunami, some contingency. It will increase the risk. If the increase is rising in the economy, anyways, it will hurt the intensity of the companies to generate cash flows, right? And anyways, your cost of capital in that scenario will also rise. So any type of risk, the P will be impacted. An improvement over this P ratio is something which is called as PEG ratio, PEG ratio, not the peg that you drink, right? But something which is a metric, price earning growth ratio. Here, G stands for growth. It's a ratio, price earning growth ratio. It's an overcome, it's trying to overcome the, I would say, the drawbacks or limitations of the price to earning ratio. Right? So, how will it overcome the limitation? You have the price to earning ratio in the numerator divided by the rate of change of EPS. I have denoted this triangle. It represents delta and delta represents change. And these arrows are up and down of EPS, right? So pura price to earning that we calculated, it is the last ratio like which I will try to touch upon. In the next session, we'll do price to book. Okay. So pura price to earning that we have calculated, we put that in the numerator. And in the denominator, you have the rate of change of EPS. Now, what do I mean by rate of change of EPS? अब यहाँ पे I was saying in the price to earning ratio, a 1 year EPS, it doesn't give me a clear indication. If my last year's EPS was very high, it doesn't mean that my this year EPS will also be high, right? If my last year EPS was very low, it doesn't mean that my this year's EPS will also be low. If IT companies gave you huge returns for 2 years in terms of the profitability, now they aren't giving any returns, correct? In terms of PAT, सब कुछ flat है. Right? So past performance doesn't always indicate a similar future performance, right? So I'm a rate of change of EPS. Here I'm not taking just 1 year ka EPS. I'll be taking multiple year ka EPS. Either I can take a 2 years EPS. I can have last year ka EPS as 5, last year ka EPS as 2, and I can take a percentage growth rate in EPS, 5 minus 2 by 5 karke, right? 3 by 5. So whatever I get, right? Some 60% का change आया है. So by 60% my EPS has increased. So I'll be putting a 60% का number here. It has increased by 60%. If it has decreased, it will be a minus का number. Sometimes people tend to take a 5 year का number because 2 साल में भी क्या पता चलना है. तो if my current year is zero, पिछले 5 साल में वो फर्स्ट ईयर का लेंगे ईपीएस, फिफ्थ ईयर का लेंगे ईपीएस. फर्स्ट ईयर का 20 था, फिफ्थ का अगर 45 हो गया, राइट? So they'll be calculating a CAGR. We'll be doing such stuff practically also. मैं बस समझाने के लिए बोल रहा हूँ. हम CAGR कैसे निकालते हैं? बेसिक फॉर्मूला, फाइनल वैल्यू माइनस बिगनिंग वैल्यू टू द पावर ऑफ 1 by टाइम पीरियड, that's 1 by 5 minus 1. The formula for CAGR, compounded annual growth rate, which takes into account the compounding effect, right? फॉर्मूला अगर नहीं पता तो लिख लो. इस योर फाइनल वैल्यू minus your beginning value to the power of 1 by time period, 1 by n minus 1. So here the fifth year ka final EPS is 45. Initial year from which we are comparing EPS is 20. 5 year ka time period है 1 by 5 minus 1. So whatever answer I get after calculating it, I'll put it here in my denominator. And that gives me a much more clear indication about a company's valuation. And the suggestion is for any company you are using PE, correct? For any company that you are using PE, also calculate PEG. PEG should be given much more weightage than PE. There are many stocks who are sheerly overvalued in the bubble territory, in the small cap and mid cap space, based upon price to earning. They have crossed 100, 200, 150 के price to earning ratio पे बैठे हैं. But based upon PEG, they're closer to fair valuation or they're closer to undervaluation. Now, how to judge कि ऐसा कोई नंबर है जिसके बेसिस पे we can think कि 2 का नंबर है and the stock is undervalued, 2 से ज्यादा है, it is undervalued, not ideally. Usually in case of price, PEG में है, but usually in case of price to earning, we tend to compare the averages. If a company on which I'm researching upon, hypothetically, just to give you an example, we'll do it practically also. If a company is X from an IT sector, the price to earning of that company is 55. Then how will I get to know that is my target company on which I'm doing the research is undervalued or overvalued? Right? Since my company belongs to an IT sector, then I'll be taking what is the average price to earning of Nifty IT over 5 years or 10 years. Correct? Because Nifty IT will comprise of all the top IT companies in India. Correct? So I will see in an IT index, be it a total index, which has a large cap, small cap, a mid cap IT. If the average valuation or average price to earning over a 5 year basis is 40, then I mean I'm standing at an overvaluation. Correct? Because average the 5 साल का is 40 now, and my company ka price to earning is 55. But if my ratio is 30 and the average is 40, it means I'm undervalued. Correct? That's like one way to look at it. But the thing that can happen is average is 40, my price to earning is 55, 60 or 70. I might think the company is overvalued यार, company कितनी महंगी है. And usually in your bookish knowledge, right, or in your finance books, we tend to learn to buy something when something is cheap. Buy a stock when something is cheap, when something is undervalued, when something is trading below the long-term averages. And always sell something when something is overvalued or something is trading above the averages. Right? So in this case, 55 ka P is trading above the averages of 40. Right? It means that we should sell it off. Not always. This specific company might be exhibiting higher growth than the other companies in the index. This company might be an outperformer based upon different parameters, be it cash flows, be it fundamentals, be it the growth projections, market sentiments के basis पे. तो हो सकता है इसका multiple आगे जाके 60-70 हो जाए and it might become a multi-bagger. So can't just have that bookish knowledge कि buy something when something at a low PE and sell something at a high PE. Even buying something at a low PE might be wrong. That stock might be a penny stock. घटिया कंपनी हो सकती है कि market sentiment is negative, cash flows are very bad, the profitability is very bad, the company is a very weak bankrupt company. It might be trading as a penny stock in the market, but cheap तो होगी ना on a price to earning. So purchasing that company on a price to earning basis, right? Will that be correct? Of course not. Right? And selling of an overvalued stock which exhibits growth like Zomato, like Zepto, right? Like Policy Bazaar, overvalued companies, but they have that growth pipeline. They will grow far ahead. If people are not purchasing such companies, they're missing the lost opportunity. How to assess all these things we'll talk about because बहुत metrics देखने पड़ते हैं. And always compare your company with a similar company in the industry. IT company can always be compared with the IT index. You can't compare Infosys with Tata Motors ka P. You can't compare Infosys with DLF Real Estate. Correct? So always compare your company with a similar company in the industry. Do not make a mistake of doing a cross sector P ratio valuation comparison. And your PEG ratio overcomes all these limitations. Right? So all those indices, all those stocks might be sheerly overvalued. Price to earning might be suggesting to sell off that stock, बेच दो, but your PEG ratio might be decent. So usually in case of PEG ratio, we see if the PEG ratio is less than 2, the PEG ratio is less than 2, it means it's a good pick. It's a good pick. But if the PEG ratio is more than 2, it means something is not supporting. And PEG ratio less than 2 कब होगा? When the year-on-year change in EPS is rising and earnings are supporting the valuation. P it was just 1 year earning. We had no back track record. But here you have the change in earnings on CAGR basis. Correct? Change in earnings of CAGR basis. That's much more than the price to earning of a company. Year-on-year earning or a CAGR based earnings are quite solid, and that is why PG less than 2. Simple maths. But if your earnings start to decline, your PG will be a greater number, more than 2, more than 3. In that case, we need to be much more cognizant about the markets, right? If you talk about Nifty 50 index, right? So there's the last point I'll discuss. Okay. Everybody is saying, as of this particular point of time, purchase Nifty 50. Isn't it? Yes or no? Are you guys aware and track the market? As of this particular point of time, everybody is saying purchase Nifty 50, top 50 market cap companies. They're fairly valued or closer to fair valuation. Mid cap and small cap is overvalued, right? Yes or no? Are you listening to such kind of commentary in the market nowadays? People are saying that mid cap and small cap companies are sheerly overvalued. Do not purchase them. Their price to earning multiples are very high. A bubble territory has been there. But if you see the PEG ratio, the PEG ratio of the small cap and mid cap space is less than 2. 1.6, 1.7 पे trade कर रहे हैं हम. And Nifty 50 cat is more than 2. Correct? So that is something we need to understand. ठीक है? So this was about today's session. Anybody has any queries? Sir, what is the PEG ratio of mid cap and small cap? Around 1.6, 1.7. And for Nifty 50, it's around 2, 2.1. How? Nifty 50 का Nifty 50 का current price to earning, if you see, around 23. Market is expecting an EPS CAGR of 10% for next 2 years. 23 by 10, 2.3. Nifty 150 mid cap index, if I talk about, the current price to earning is around 35. Around 35. ठीक है. Market is expecting a 20% growth rate in terms of EPS, price to earning, for next 2 years. So 35 by 20, almost 1.6, 1.7. मिड कैप के अगर मैं स्मॉल कैप की बात करूं, या निफ्टी 250 स्मॉल कैप इंडेक्स, तो प्राइस टू अर्निंग इज अराउंड 33 एज ऑफ टुडे. द ग्रोथ रेट कितना चल रहा है? द ग्रोथ रेट एक्सपेक्टेशन द ईपीएस सीएजीआर फॉर नेक्स्ट 2 years इज अराउंड 17%. 1.6, 1.7 का स्मॉल कैप भी चल रहा है. Right, so small cap and mid cap, they tend to become much more appealing. I'll share these numbers with you also, right, for the purpose of investment. Correct. So that is how, and once we do the financial modeling and valuation, I'll tell you कि भाई ये चीजें हम कैसे index का देख के we are calculating. Any question, anybody? If no more questions, then we can end the session as of today. All right, and get back in the next week. Hello guys. Okay, see you. Thank you so much. Take care. Bye.